Anyway, how y'all doing? This video right here is a class I give on my investment strategies. Check it out. Probably like 7 more to this series. I gave this class a couple of days ago to a friend that's in North Carolina. I'm still out here in Houston, newly retired. But if you got any investment questions, hit me up. Like and subscribe. So check out the video and let me know what you think. So basically, like I started investing when I was 18. 18, I had my first brokerage account. And so back then, you actually had to get an appointment with a stockbroker, and one trade was just on the buy or the sell side. One trade was $50.
Wow.
So to sell one stock or a million stocks at that bank, it costs $50. So fast forward to now.
How old are you now, bro?
Huh?
How old are you now?
I'm 43. I turned 44. Yeah, I turned 44 in June.
Okay,
so,
gotcha.
So I started 18, but it's a break in it. So 18, I dibbled and dabbled. I bought some bank stock of that bank. And I went to First Command right out of college. Had them do an IRA. And then circle back, fast forward to probably about 31. That's when I took it. And I closed my First Command. I took all that cash. I cashed that out. And that's when I got into the market and started doing it myself.
Gotcha.
So it also in that time, I got an MBA, whatever. That helped a lot, believe it or not.
Sure.
So that's kind of like my investment background. I'm not a licensed professional or financial advisor, none of that. But I wrote a book on it. I've been doing pretty good as far as investing.
What's the name of the book?
Right down the top, right here. Okay. Soldier's Financial Handbook Uncut. It's on Amazon.
Okay, definitely.
So let's get into it. So like with this slide, initial slide, everything revolves around your goals, your investment, your career, your business, your family, property, spending habit. All that helps show a full picture of a common operating picture of what you look like financially.
Okay.
All right, so let's talk about assets. You got depreciable assets, you got appreciable assets. Obviously, y'all too smart guys. I'm not going to insult your intelligence, but it is a lot of caveats on appreciable and depreciable. So, like cars, obviously they're the depreciable asset, but certain cars appreciate.
Right.
Certain jewelry appreciates. When I talk about jewelry that appreciates, I'm talking about watches, which I got educated on this year from a friend of mine. So these are not cut and dry, but it is a caveat on every one of these. Even the land can be depreciable, businesses can be depreciable, but my go-to vehicle, which I think is easier to get into than real estate and businesses, are stocks. You don't need but like $10 in a cell phone. You can get into the stock.
Got it.
Y'all got any questions on this one?
No, it's good. Good.
All right. So this question, this slide is kind of like giving you. This slide will help you understand CNBC or Fox Business or whatever you subscribe to or whatever you watch.
Right.
I'm gonna go through each one of them and stop me if you have any questions.
Okay.
So I'm gonna go from top right to left all the way down to the bottom. So dividends. Dividends are basically money the company pays you for being an investor and holding the stock. So dividends are paid monthly or quarterly. I own some monthly dividend stocks. I own quarterly dividend stocks. A very popular one that everybody knows is KO, aka Coca-Cola. Coca-Cola been paying dividends since forever. I think it's a movie that somebody had a Coke certificate of a stock from way back in the 40s or 50s. But Coke is I own it. I swear by it. If you don't like Coke, you buy Pepsi. If you don't like Pepsi, You could buy Dr. Pepper. All three of those companies pay dividends. So a lot of companies don't pay a dividend. Some companies pay shitty dividends, like Apple. Apple's a good stock. It runs up. It goes up. It has a great history, but the dividends is real minute, to say the least. Okay, bull. The word bull and the other word is bear. Let's do those together. Bull and bear. So a bull market is, when they say it's a bull market, that means the market is going up. Okay, what the hell does that have to do with a bull? What does that have to do with a male cow? So when a bull attacks you, he flips you up. So like if you watch a rodeo, when that bull get loose on those rodeo guys, he flip them up. So that we're bullish. When they say I'm bullish, that means they're predicting or saying the market is going up. So a bear is most times 8 to 10 feet tall, maybe sometimes 12. And when a bear attacks, he claws down, and the market is going down. So they say I'm bearish on, say, the market or the stock on oil. Bearish means down, bull means up.
Got it.
IPO. IPO is initial public offering. So what's so popular? Beyond Meat, the fake meat, the meat stuff, whatever the hell it was. It had an IPO. Roku had an IPO, which is in every TV now. Both of those I got to play in on. I watched them before they hit the market. And the day of the IPO, when I say we, like the people, like I guess my friends, we made some good money off of. I made a lot of money, Roku, and I made some good money off of Beyond Meat too. But I got in, got out, got my money, got out. So the IPOs are new companies that's just becoming publicly traded.
Where would we find that information? Like, where do you get the inside trading on Beyond Meat coming open? Like, where do you?
So you can just Google January IPOs, right? And it'll show you what's coming out. It'll be on the NASDAQ website, and it'll show you what's coming out as far as IPOs this month and next month. They go about 3 months out sometimes, but most time they got the next 4 weeks really laid out as far as the IPOs and whatnot.
Okay.
So that's IPOs. The IPO market's kind of dried up because it's costing the upstart business too much money to borrow money because the interest rate is up. So it's kind of the IPO market is kind of like, who cares? You know what I'm saying? So it's kind of been dead for like the last 18 months. I hadn't invested in an IPO in almost 2 years. So EPS is earnings per share. Earnings per share is kind of like a discriminator word that's used on earnings call. So every company, every quarter has an earnings call, and you'll see the stocks do one of three things. They kind of like flatline, they don't do nothing, they go down or they go up. So EPS is very important when it's an earnings call for a company. All right, and the word position is basically the number of stocks, the number of shares you own for said country. So company, like my position in Apple right now, I want to say is, I think it's 40. I think I got 40 shares of Apple. I got a lot of shares of Amazon. So that's my position. That's how many shares I own in that said stock. So like I used to own a big position of something, a lot. I dumped the position in Sony and I took that money. I think I put it in Google. So that's just the word position. All right, beta. So beta is basically a unit of measure, is basically saying the volatility of said stock. So if you want your beta to be low, like a low below 1 or 1, 2. But beta works two ways. If you got a high beta, that means it's volatile. So volatility can work both ways. Volatility can mean something negative, or volatility can be something positive. So Tesla is both. Tesla stock, which I've been having position about 2 years in Tesla, can work both ways. But as we pull back and as the years go by, it's going only one way, up. So that's beta. So resistance is this. So like with certain stocks, they hit their top. So say Oxner Water. I'm looking at a bottle of water. Oxner Water Company, right? My stock, say it's $45 right now. The resistance is the price of that stock that it won't go through. So it'll get to 49, it'll never bust over 50. So 50 is the line of resistance.
Who makes the line of resistance on that bottle of water?
So the resistance line. Oh, I shouldn't have did that. The camera saw me. When you do the L shape, the camera it followed me. See, now it's following me.
I got you.
So the resistance line is dictated by the market. Mm-hmm. Certain stocks only hit, as far as price wise, they only hit certain points. Okay, so like with at one point, Coca-Cola never went over $60 a share. Mm-hmm. So when it hit 58, 59, and then it would never go below 55. So if you get close to 55, that's when you need to be buying.
That's when you gotta buy, yeah.
So it's two lines. I don't want to let it see my head. It's two lines. So the support line is the lowest. So the support line for Coke at one point was like $54, $55. So if I know if I see, Coke had some bad news, say New York outlawed large Cokes or something, which they did at the time.
Okay.
It went down to 53. It's time to rush. It's time to buy. It's my chance to buy, because I know it doesn't get below in its Coke. I know that it's going to bounce back. I'm going to
$59.99 right now.
How much is it right now?
$59.96.
So it got up to 62. Listen, it's certain stocks.
Yeah.
I don't want to get off. I cover that later.
Good.
All right. So the support line is the bottom. So when Meta, aka Facebook, had the congressional hearing where they were on Zuckerberg, they were on him hard. Mm-hmm. They had their foot on his throat, and the stock went like 20, a negative 20 that month. Right. So I'm like, man, this is just my time to shine. So I went in, I think I might have sold a Sony and went right into Facebook, aka Meta, and I'm up like 100% right now. So, and another one that I missed out on was Starbucks. Mm-hmm. Starbucks, when they had the bad news in Philadelphia with the two black guys.
Yeah, right.
They went down. They had like a negative 9% day, I want to say. Mm-hmm. And I was telling people, hey, this is your chance. This is your time to shine. And I should have invested. It hadn't been down since. It hadn't been.
Jeez. Right. You got to jump on it once it's low.
Yeah. So the support line. So a lot of time, if the stock I do a year support line, most of the time 3 months. If they got a support, I'm going to show you this on the chart too. If they have a support line they fall below that support line, and it's a good company, you might as well go ahead and buy. Because unless it's something like Beyond Meat, I wouldn't do nothing like that. Because it's if it going down, it's because it's trash.
Right.
All right, so that's support and resistance. I talked about bear, large cap, small cap. Basically, this is it. So large cap companies are Apple, like large market capitalization, $1 trillion. Like GE, large cap, Beyond Meat, small cap, somewhat. So the small cap companies are more volatile than the large cap companies. Like obviously Apple won't do a negative 19% day. It'll never happen. You see what I'm saying? So it's more I would say as you design your portfolio, you want to be, especially if you're a beginner, being more large cap companies than small cap, because small cap companies take more bandwidth far as moving it around and just being cognizant of what's going on, because you don't want to blow your money.
Yeah, is Lucid considered small cap?
I would say yes. I would say
Okay.
what's the market cap on it? Like, what's the market capitalization on the company? Is it like, if it's $1 billion? We could look it up, but
yeah, I got you, because the ones that Coke is large cap, Tesla's large cap, Apple is large cap, right?
Yeah.
What's the threshold for large cap?
I would say I would say billion. I would say $1 billion.
Okay.
And then small cap,
Lucid's 8.9
billion
market cap. Yeah.
8.9 billion.
Well, it might as well be 9 billion.
Okay. So I would say yes. But like when I made this slideshow in 2019, so
yeah,
8.9 was large cap back then. Like,
got it. No problem.
Compare Lucid to damn Apple.
Ooh.
3 trillion. So
yeah.
I would treat Lucid like a small cap company because of their competitors. Their competitors, they're light years behind.
So are you bearish? You're bearish on Lucid?
I am, because I'm not saying I'm bearish. It's just, let me think about this. Why go to McDonald's when you can go to Morton's?
Right. Yeah.
So I'm calling Tesla Morton's.
Right.
I'm calling Lucid McDonald's.
Right.
Is that fair? Probably not, but that's just my
that's your analogy, right? That's your opinion.
So you're big, and Ronnie and I talk about this a lot, about individual stocks, like individual company stocks, as far as investing compared to mutual funds,
or
ETFs, indexes.
Okay, cool. All right, cool. We're on it.
All right, so symbols are very, listen, hold up, let me go back. Damn. Okay, symbols can get you in trouble.
Yeah.
So remember I told you about Coke, right?
KO.
It's another Coke on there, COKE.
Oh, really?
Yeah. So this again, he said buy Coke, and you go COKE in Robinhood, and it's Coca-Cola Bottling Company. It's 2 different companies. It's 2 different corporations. You want to be in KO.
Wow.
So then, like, if you fat finger Tesla, if you put TLSA instead of TLSA, TSEL is Tesla. If you put TLSA, it's like a 20-cent stock. You're like, oh shit, Tesla's down 20 cents. Wrong. You got what is this shit? So that's my definitions. I like to use these as like a baseline. This will really make you dangerous. These definitions right there.
That's good. I learned a lot so far, bro.
Yeah.
All right. Great.